I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance, the leading association for lower middle market private equity funds and investors. The SBIA is an alliance for professional fellowship, business opportunities, innovation, regulatory expertise, and market data, and works on behalf of its members as an advocate for policies that promote competitive markets and robust domestic investment for growing small businesses. We are pleased to launch our fall Lunch and Learn webinar series with today's session, Equity and Debt Co-Investing in Lower Middle Market Financing Transactions. Our educational webinars provide valuable content for our members, industry colleagues, and, when the topic is relevant, the management teams of investor-backed portfolio companies. Before we get started, I'll cover just a few housekeeping items. In your GoToWebinar menu bar, please find the questions feature. We'd love to make today's session very interactive, and you'll be prompted throughout the presentation to share your thoughts and experiences here. If you have questions, this is where you will submit them as well. And please use this feature to let us know if you are having any technical issues. Today's technical director, Ainsley Stoy, will reply with suggestions. Finally, you can find and download a PDF of today's presentation under handouts in this menu. Please note that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded without approval by SBIA and the professionals at Locke. Today's session is possible due to the support of our silver sponsor, Locke. The professionals at Locke represent SBICs, mezzanine, senior debt, venture, growth, and buyout funds, and their portfolio companies. A global leader in the middle market sector, Locke services clients ranging from Fortune 500 and middle market public and private companies to startups and emerging businesses, operating out of 20 offices around the world. Today, we welcome Locke partners Tamara Tolgren, Christine McKay, and Mike Wilson. Tamara focuses on representing private equity and venture capital firms, SBICs, and other investors in equity and debt investment transactions, fund formation, and regulatory matters. He also counsels growth-oriented technology companies and middle market businesses on M&A and financing matters. Joining Tamara, we welcome Christine McKay. Christine represents financial institutions as well as private equity sponsors and public and private operating companies in a broad range of debt financing transactions, including syndicated senior credit facilities, second lien, mezzanine, and subordinated debt financings, and distressed debt investments. Finally, we welcome Mike Wilson. Mike handles mergers and acquisitions, debt transactions, venture capital transactions, and general corporate matters for private equity funds, startups, banks, insurance companies, and other public and private businesses. Mike has significant experience representing funds and limited partners in portfolio investments, limited partner investments, fund formation, and SBIC licensing. Tamara, it is my pleasure to turn the virtual podium over to you to get us started.
Okay, great. Is my screen being shared correctly?
Good, Tamara.
Good, okay. So just at the outset, because my screen is being shared, I actually can't see myself or the other panelists. So if my hair is out of place, Mike or Christine will have to let me know. Okay, so thank you all for joining. At the outset, and here let me do my job of transitioning screens here. Here we go. So in this presentation, before we get to this slide, actually, economic considerations, just want to kind of set the table a little bit because co-investing can be a very broad term or concept, and what we're really talking about here is a situation where an investor, typically a fund, is investing in a private company, and often lower middle market to middle market company or growth oriented company, and making a minority equity investment, but then alongside that is making a debt investment where the debt investment that investor is a lead or significant investor in the company. So the minority or the equity investment is minority, and we're generally assuming that there's a sponsor or independent sponsor involved in the deal. And again, with the debt, this is typically a secured loan or it could be unsecured, but where the investor is the lead or significant debt investor. So given that background, we're not really going to cover the situations, well, I should say we're going to focus more on the equity side of the transaction, although one important aspect of this that we are going to cover is the interplay between the equity and the debt from the viewpoint of the investor that I just described. So we're not really going to cover intercreditor agreements between, for example, a first lien lender and a second lien lender, or senior and subordinated. But we will cover the interplay between the equity and the debt, and again focus on really the equity side of the transaction in terms of minority equity rights and protections for the investor. And also, since a lot of the audience, or I should say there are audience members here and that comprise membership of SBIA that are SBICs, we will touch on some of the SBIC regulatory specific issues that come up. And so, one other note, as you'll see in the slides and in the discussion, we're going to be talking about protections that investors should be thinking about in this situation, but a lot of this does depend on negotiating leverage and the specifics of a particular transaction. So, is the investor a very small minority investor in the equity with, a sponsor that has a very significant stake, or does the investor have a significant minority stake? And also other variables include, the equity or the check size of the debt. Is the debt investment very significant when you look at the overall capitalization of the company and the investment at issue? So in that sort of situation, even if an equity investment might be relatively small, if the total check size is larger, the negotiating leverage, there's variability. That's all I want to get across there. And one of the things that we would love to hear is during the presentation, you might those in the audience might be thinking, well, I've done a deal and I was able to get such and such rights, or I was able to, I have never been able to get this. And that's certainly, we expect there are going to be difference in experience, and we'd love to hear thoughts or questions or comments related to that as we go along, and you can send those in the chat function and we'll bring them up as we go. So the last thing before we jump into this slide is, so the three presenters here, myself and my partners, Mike Wilson and Christine McKay. Christine is one of the co-chairs of our debt finance practice. We'll be generally talking to the debt finance aspects of the slides. Mike more so with the equity, and myself more of the SBIC focus, but also some of the equity. But these transactions, really, there's a lot of overlap. At least that's how we work. So, Christine, if she's focused on the debt, she's going to have a good understanding and a handle on the equity issues that are going on in the transaction, and vice versa. And frankly, that's what makes these deals quite interesting, actually, is you get to be involved in the debt and the equity and kind of all sides of it. So with all that being said, economic considerations. So we're going to get into more specifics of provisions in kind of deal terms and transaction documents later, but thought it would be helpful at the outset to just take a step back and think through what are the economic things that are really driving the more technical or specific provisions we're going to talk about. And so that's what this slide, or what we're going to talk about here. So generally speaking, if you are a minority equity investor, you want to think, you are thinking through, I am not in control here. So what are the ways in which I can ensure that I'm going to realize on this investment, both from an ongoing operational standpoint, through tax distributions, for example, in order to be able to pay taxes, through exit, and what if there isn't an exit in the time horizon that you were expecting or anticipating when you made the investment. So just to kind of go through some of this, we're assuming, so in the first bullet, just referencing class or series of equity interests, we're assuming, and what we often see in these situations is the investor getting a piece of the same equity class that a sponsor gets. Usually it's preferred. Sometimes we do see warrants, not very frequently these days, but we do see warrants, and often what I see in warrants is those being for the purchase of common stock. And then kind of going through the other economic aspects that are driving this here. The distribution waterfall, which really goes hand in hand with exit and tax distributions. So if you're getting preferred equity, which is often the case, that means you're coming ahead of the other shareholders, in particular common shareholders like management. And that's usually the expectation that we often see investors are expecting, is to get preferred. And so that can mean a lot of different things, but fundamentally it is you have a priority in the distribution waterfall. There are nuances around that which we can get into, but that's kind of the fundamental piece of it. And then exit and redemption. So just because you have a priority in the distribution waterfall doesn't mean that you're going to get any distributions. There have to be distributions that are made. And so that there are protections around that, or structural parameters around that, in that usually what we see, or what investors would expect, is that if any time a distribution is made, the distribution waterfall has to be followed. So that priority has to be followed anytime a distribution is made. It's not as if the company or those in control can make a distribution and not honor that distribution waterfall priority. And then the situations where, just because, again, there's a distribution waterfall and there may be distributions, that doesn't mean that there's required to be an exit, that the company is sold. So sometimes, although not always, we see redemption rights that minority holders have, because again, they are not in control of the company and can't decide, it's been 5 years, it's been 10 years, we want to sell the company. So sometimes we do see redemption rights and put rights to give comfort that there will be a liquidity event for that equity piece at some point in time. Tax distributions, so this is always important, and in the conventional wisdom, as many have probably seen, is that taxes are going up, kind of all kinds of taxes, entity level and personal taxes are likely to go up at some point in the near future. How's that for a vague prediction? But it does seem likely that that's going to happen. So tax distributions are critical to ensure that the investor is able to have cash in which to pay taxes on earnings, which you otherwise might recognize tax but not receive cash to pay those. And one really kind of key point here, and later we're going to get into the interplay between debt and equity, but I do think it's worth pausing here, Christine, if you want to provide a couple thoughts on the interplay, because I mean, it's one thing to have tax distributions in the equity documents, but if the debt documents don't allow them, you know, there's limited value to those provisions.
Most certainly, and that would be problematic. So typically the debt documents are going to restrict the company's ability to make various types of distributions. But of course, as an investor in both the equity piece and in debt, it's important in the debt docs to make sure that there aren't restrictions on the company's ability to make tax distributions out. Part of that is ensuring that you don't have sort of simple restrictions like, well, no tax distributions if there's during the continuance of an event of default, but also making sure that definitionally things link up so that you don't necessarily have a more narrow universe of the tax distributions that are in fact permitted to be made under the debt docs than what's in fact being distributed under the equity documents.
Yeah. And so just kind of finishing off on this more general overview, anti-dilution protections, which will come up in a bit more specificity later. These take a couple different forms, but I usually see these in the transactions of the types that I described earlier. I usually see these more as preemptive rights, where the minority equity holder might not have the ability to block or veto the issuance of new equity, but would at least have the ability to invest a pro rata amount to retain a particular percentage in the company if that's important to that investor. It can take other forms, like one I just alluded to, and this is a negotiated point, but veto rights of an investor or a class of investors over the ability of a company to issue new equity. Also, what you often see in venture capital financings is anti-dilution protections in the form of automatic reductions in the conversion price from preferred to common if there's a down round of the company, if the company issues shares later at a lower price than the shares purchased by that investor. Again, I usually see that in the kind of the more prototypical venture capital type financing round than the one I described that we're kind of focusing on here. But definitely open to hearing different thoughts from our panelists as well as the audience on any of these. So I am going to kick it over to Mike. Mike, I probably covered generally some of the things on this next slide, but feel free to react to anything that I just said, or kind of just go into the next piece here.
Yeah, well, Tamara, you hit on one of the key sets of protections around anti-dilution protection, but obviously investor protections tend to be the most heavily negotiated element of an equity investment, whether that's a co-investment with debt or a standalone equity investment. This is really one of the places where the rubber meets the road. There's a broad range of outcomes as to what consent rights you can get as an investor when you hold equity. A lot of that depends on a number of different factors. You know, the size of your investment obviously matters. Where you're doing debt plus equity, if you're writing the biggest check in the deal, you know, you're going to get a broader range of consent rights than if you're, for example, coming in with a smaller mezzanine check and a smaller equity check. You're just likely to get less in that scenario. But there's a series of tiers of types of consents you can get, and I would love to hear from the audience if you want to type it into your chat box. You know, what are the essentials? You know, what are the really core consent rights that you won't do a deal without? And then when do you need more? When are you asking for more than just baseline? So I sort of separate the consent rights into 4 tiers. There's the mandatory tier. There's sort of the really important tier. There's the more operational but still important tier. And then there's really the nitty gritty, you know, operational type rights that look a little bit more like negative covenants in debt than they do, you know, sort of the core equity consent rights. To us, the mandatories are things like affiliate transactions, amendments that would affect our equity in any way, you know, no waiver of preemptive rights without consent, assuming we get a preemptive right, as Tamara was talking about. Those are sort of the core that you can't do anything else. Schmuck insurance is what I usually call them. They're sort of the things that, you know, the sponsor could screw you around with if you don't have. The more important things get into things that are sort of, if you've ever done an NVCA form deal, a venture type deal with the National Venture Capital Association forms, there's a series of consent rights that they have in their form charter that are sort of the higher level ones. Things like sale of the company, amendment to the organizational documents, creation of new stock. You know, Tamara sort of hit on that with the anti-dilution protection. Oftentimes you'll think about getting a block on senior stock. That's something, again, that you probably have to have a little bit more sway in the deal in order to get. As a sort of small minority investor or writing a smaller check, you're not going to be able to stop the company from doing future issuances because they need flexibility to do that. But if you are a really important check size to the overall deal, you're more likely to get it. Sometimes, although I think very rarely in these types of co-investment scenarios, you can even block all future equity issuances. I rarely see that in these scenarios. It's really more about, you know, that happens more if you're a significant equity investor, sort of standalone, taking near control of the board or a big chunk of the board. You know, purchasing or redeeming equity, so scenarios where you can start to pay off the management team by taking out some of their equity, that's another spot that you often have the ability to block. Similarly, creation of incentive equity plans or increasing the size of those, that's another spot where when you think about siphoning off capital to management, that's really where you're going to want to throw up a roadblock potentially. You know, the other thing, especially if you're a senior debt class, being able to block additional debt, sometimes all debt, sometimes just secured debt, oftentimes subject to a certain size threshold. Usually we have carve outs for specific sizes of debt that you can still do sort of in the ordinary course. Changing the board size, again, it depends how much control over the board you have. Those are sort of that bigger picture tier of consent rights. And then when you step into the more operational things, that's really things like if the company's making loans, guaranteeing debt, changing terms of equity or compensation to management team, starting to get into even things like if you're an IP, you know, an IP heavy company, technology company, selling or encumbering that as a material asset becomes something that you can think about restricting. That nitty gritty operational style covenants, you know, negative covenant style, those are really better addressed in this type of scenario in the debt documents, just because they can get pretty extensive and you're probably already covering many of them in the debt docs. Christine, you see the interplay. I rarely see these two, the equity consents and the negative covenants negotiated together, but they really do often cover a lot of the same topics.
Yeah, they definitely mesh together. And I think what's interesting here is that, you know, as an investor in a deal such as the types that we're talking about here, you're really wearing 2 different hats, right? You're wearing your equity investor hat and you're looking at the investment from, you know, from the perspective of an equity investor, but then you're also wearing the hat of a debt investor, looking at the investment from the perspective of a secured or an unsecured creditor. And in both instances, it's in your interest to establish parameters around the company's ability to take many of these actions. It's just that you're probably coming at it from two different angles and establishing those parameters for different reasons. But in the debt context, the other thing that I think colors this is, for instance, if what we're talking about is a sub-debt investment as opposed to a senior debt investment or a second lien investment as opposed to a first lien investment, your debt documents are oftentimes going to track the senior debt documents. And so the negative covenant coverage that you have in the debt documentation is in many cases going to track what the senior lender is focusing on. And of course, Mike mentioned a lot of these different types of protections in the equity context, but in the debt negative covenant context, what we're looking at are things like restrictions on the company's ability to incur additional debt. Well, you'll have all sorts of negotiated baskets, and it'll get into a much more granular level. The company's ability to incur additional liens, asset dispositions, an outright sale of the company or change of control types of events, ability to amend the organizational documents in ways that could affect the interests of a debt investor, transactions with affiliates, et cetera, et cetera. And I think the takeaway here is that although you're very much looking at the investment from two different perspectives, there's a lot of commonality in the types of protections that you want to get.
Yeah, those are all great points. The one kind of related thing I would mention too is when you're negotiating the equity and the debt, you do also need to think about so that it's possible that there's just going to be one exit where you exit both at the same time, but it is possible that the debt, for example, is paid off, and then you retain the equity investment beyond for a certain period of time beyond that. So you do have to think about, there's commonality, but if the debt's not there, do I have sufficient equity rights without the debt negative covenants as well?
And on that point, sometimes what we do is have a bifurcated set of equity rights where you're having a more significant set of equity veto rights while you have the debt in place, and then some of them fall off when you just have the equity and the debt goes away. When you think about the theme of the check size helps dictate how much you get, when your check size is significantly reduced, then maybe some of the rights fall off. Not something that we love to do because as an investor, because we're giving up things, but it can help make the negotiations easier if there's significant discomfort about really long-term controls over the business. One comment we got from the audience on these sort of the lists, in the spirit of not sort of carving out money for management or for the founding team, is making sure that you exclude the founder or the controlling stockholder from participating in any incentive equity pool. That's something that really across the board we try to do. You want to limit the ability of the controlling investor to take additional capital out of something that was really meant to reward management or incentivize management or act as a recruiting tool. So that excellent comment from our audience.
Yeah, one thing on that, Mike, I would just say, would you say though that there's a distinction between controlling stockholder and a founder who is currently, leading the company as the CEO? Because I would think that person is that latter scenario. That person would expect to get, that there would be incentive equity. Like, I'm talking about the situation where you have, a sponsor, you have the minority equity, and then you have founder/management. I would think that the founder/management would expect to have some of that.
Yeah, I think that's right. I mean, that's typically what you see, but you do want some guardrails around it. I mean, if you assume that you're not getting in bed with a greedy founder, but if, for example, you are, you want to make sure that he can't use the entire incentive pool for himself to the expense of the company. But yeah,
Right. Yeah, if they control, right. Yep.
The last piece of this that I want to cover is really sort of the when do you need more than the essentials. We talked about check size being part of the equation, but there's more that goes into it from an investor perspective, thinking about when you really need to sort of push for those things. If you've done deals with the sponsor before, if this is a really well-known sponsor, they've got a committed capital fund, they've done a lot of deals with people they've got the track record. Oftentimes those will be scenarios where you don't need quite as much in terms of consents because you do know and trust them. But if you have somebody that you haven't worked with before who doesn't necessarily have this significant track record, single asset fund, sometimes independent sponsors, those are scenarios where you really want to think about protecting yourself from the unknowns. You don't want to say shifty sponsor, but I'm going to say it anyway. If you got somebody that you sort of trust but don't fully know, that's when you start raising your hand and say, I really do need some of these things in place to protect our investment.
Yeah, and on that point, we certainly see, we work with clients that work with the same sponsors very frequently, so there's a lot of trust, and so the negotiation isn't as strong or adverse on both sides. So yeah, there's a lot of there's a spectrum of that for sure.
Well, and to your point, Tamer, it goes both ways. If you've worked together before, there's a level of trust in the investor as well, that they're not going to be arbitrary or unreasonable with the way that they exercise their veto rights. So, it certainly goes both ways, as is the company. If you know the investor and you know how they operate, and they're reasonable people who want to achieve mutually beneficial goals, maybe you're more willing to give some of the bigger picture veto rights because you're not as concerned about it coming back to bite you. I've definitely seen that happen before, where you have a lot of trust between the two sides, and there's sort of there's an unwritten understanding that it's okay because nobody's going to try to mess with anybody.
Right. Okay.
So the rest of these rights, these are really fairly customary minority equity holder rights or equity holder obligations that are included within investment documents. I'm sure most of our attendees have seen these and thought about them before. A little bit different than veto rights, but also important in terms of protecting your investment and your position in the company. Preemptive rights, Tamer touched on, very important to have the ability to maintain your equity stake in most scenarios. I think most investments come with preemptive rights. There are exceptions to preemptive rights, things like management incentive equity, add-on acquisition issuances is another one where we often see an exception for preemptive rights. Sometimes we see exceptions for issuances to debt finance providers. If you're going to issue, for example, a warrant to a senior credit holder, that's something that you don't necessarily want everybody to be able to participate in. But that's sort of, I think, on this list, probably among the biggest ones. Rights of first refusal, sometimes happen, I think, particularly around, management holders. If a management holder is trying to exit, you want the ability to make sure you're keeping that equity within the company. I think I see ROFRs less, other than in the context of, the venture type investment where you've got the ROFR agreement. I guess, how often do you see ROFR type rights, Tamer?
Yeah, it's similar to you. I usually see in these deals, transfer restrictions and rights of first refusal of some kind. I guess I probably don't see the kind of the NVCA type that you just mentioned as much, where it's really focused on just a transfer by a management team member of their equity. I think I see more of the kind of more general right of first refusal, where if anybody transfers either within a class or just generally, that it either goes to the company or the sponsor, and that, or it kind of follows a company first, then sponsor, then or preferred class, and then others.
Yeah. The next one, tag-along rights, that's another very important one from the investor perspective. It ensures that the majority can't start selling down and achieving liquidity without you. Sometimes those tag-along rights have percent thresholds, so there's sort of a de minimis or a small amount that can be transferred without triggering tag-along. Oftentimes for administrative convenience, sometimes for specific liquidity reasons or co-investor transfer type reasons. But having the ability to go along with other shareholders in a sale, certainly very important for a minority equity holder. It's sort of, again, the way to not get left behind and not get oppressed by the majority. Drag-along rights, oftentimes it's, that is thought of as a company-friendly provision or a company-important provision to ensure that if you're going to sell the company, everybody comes along. From an investor perspective, thinking about having that in place and ensuring that it applies to all of the management team and the smaller investors, as a minority investor, you're as incentivized to sell the company as the majority oftentimes. So ensuring that you can take everybody along without sort of having somebody greenmail the company to try to get more and hold up the deal is important. Another thing to think about within drag-along rights is what's the threshold for approval. Sometimes it's just the board. Other times it's the board and a majority of the equity. Thinking about who those stakeholders are, who controls the board, who controls the majority of the equity, is a class vote by the equity as well. Understanding who can actually take you along is an important consideration within drag-along rights. And then from a minority investor perspective, you want to think about what you're going to be subject to if you're dragged along. Certainly as a substantial minority equity holder, the expectation is that you're going to be on board with the deal and that you're going to sign up in the same way that the majority stockholders will. But if you are dragged along for some reason, as opposed to being fully on board with the deal, things like, do you have to sign up for restrictive covenants? Obviously, any fund is going to object to signing up to a non-compete. Just doesn't happen, can't happen in most scenarios, unless it's extremely limited. So having carve-outs for things like, we will not sign a non-compete. Limiting exposure for indemnification purposes, that you're several and not joint, and you're only, you can only be liable in any deal for up to your proceeds or your pro rata share. That's another thing to make sure is in there. Those help ensure that you can't be dragged along and made worse off than you would otherwise be. Did I miss anything within the drag protections, Tamer?
The only other one I could think of is the allocation of proceeds being consistent with the distribution waterfall. So, as a minority equity holder, we're assuming you have a preferred, so ensuring that if you're going to get dragged along, that those priorities are respected in the allocation of deal proceeds.
You reminded me of the other point within distribution of deal proceeds, that if there are different forms of deal proceeds, it also has to be the opportunity to have pro rata. So if in addition to cash, you're going to have a seller note or you're going to have rollover equity, as a minority equity holder, making sure that you have the same participation in those as other stockholders. If the majority stockholder is going to have the right to get a second bite at the apple with rollover equity, you want to consider whether you get that as well. Registration rights is something that we don't see quite as much in these types of deals. That's oftentimes a venture capital type concept where you have the ability to, force the company to register your stock or, do other things in terms of public offerings. Piggyback registration is one that we do see a fair amount, so that if the company registers some of its stock, you have the ability to get your stock registered as well in the public markets. Anything else in terms of registration rights, Tamer?
No, that covers it for me.
Yeah, and then information rights, this is one that dovetails really well with, credit facility information rights. As an investor, you're certainly going to want things like audited financials and obviously, K1s or some sort of similar tax filing. To the extent you probably want quarterly financials. That's often in there. Monthly financials, less so. Sort of investor type reports. if they're being prepared for the majority equity holder or the lenders, you want a copy of whatever's being delivered to the lenders. Christine, in terms of information rights, what are the mandatories that you see on the credit side, which inform the equity side?
Yeah, on the credit side, the information rights are certainly most likely going to be more voluminous, right, than those on the equity side, but they'll certainly cover all of those baselines that you just mentioned: annual audit, quarterly financials, often monthly financials. Certainly, if there are any financial covenants that are tested on a monthly basis, then you're going to want the financial statements to support those. In addition to those, there'll of course be covenant compliance reporting in the form of a compliance certificate, to the extent that there is special collateral, bank accounts, for instance, IP, things like that. You might require periodic updates with respect to those, where you have to take special steps to perfect against it. You want any notices in the sub-debt context. You want any notices that the senior debt gets. You probably want, and then there will also be the litany of notices that you would get upon various material events, like material litigation, notices of material environmental matters, ERISA matters, material adverse effect, things like that. So, some of this will be tailored to the deal and what specific terms the deal has, but there's certainly a baseline set of information rights. And so, switching gears a little bit, just to talk for a few minutes about how these two investments, kind of interrelate. Again, I mentioned this earlier. Really, you're wearing two distinct but interrelated hats as both an equity investor and a debt investor into a deal. And it's important to establish vis-a-vis the company, other equity investors, and other lender parties that may be in the deal. For instance, in the sub-debt context, a senior lender, some differentiation between those two hats that you're wearing. And what I mean by that is, for instance, in both the equity and the debt documents, you'll most likely want to have some protective provisions that are designed to mitigate claims from, for instance, the company or other equity holders related to those different roles that you have. For instance, looking at the debt transaction from the perspective of a debt investor who has certain lender rights and remedies. If you're a secured lender, you have rights to foreclose on assets and collect payments, et cetera, et cetera. And in the equity context, in the context of the equity documents, most likely you want an acknowledgement from the company that, yes, in fact, you also have this separate role in the transaction, and a statement that in the exercise of those various rights and remedies, you, as in your role as lender to the company, don't necessarily have a duty to consider in light of that role the company's interests or duties to other equity holders in your exercise of those remedies. Along the same vein, in the debt documents, there will often be protective provisions that talk about how the relationship in the context of the debt investment, the relationship between the investor and the company is one of creditor-debtor and not one of joint venturers. The lender as such doesn't have a fiduciary relationship with the company, and the debt investor in that capacity can pursue its various lender rights and remedies within that framework. It's also important to distinguish the equity investment from the debt investment in the context of intercreditor and subordination agreements when you're dealing with a senior sub-debt relationship. It to the extent that the intercreditor somehow captures the equity investment in the universe of what is considered subdebt, and the subordination terms of the subordination and intercreditor agreement somehow apply to the equity investment, that can cause all sorts of unintended consequences. One pretty extreme example of that could be that, you know, if the equity investment is sort of swept into the subordination terms that apply to the subdebt, you could end up in a situation where your tax distributions as payments that are coming from that investment get blocked when there's an event of default by virtue of the payment blockage provisions of the intercreditor agreement, and that's not where you want to be. So the best solution, or the most equity investor favorable solution, is certainly to carve the equity investment out entirely. It's not part of this intercreditor agreement, and it's not subject to its terms. It is certainly the case that some senior lenders will be very reluctant to take that approach with a blanket carve out, and they'll want to they'll want subordination terms to apply to the equity investment if there are, you know, mandatory redemption terms or terms requiring mandatory dividends, et cetera, because that's equity that's sort of acting in a way like debt, in that it's getting payments. The problem is if you take that approach and you don't tailor it narrowly enough, it could have, again, unintended consequences. And an example of that that's pretty applicable to, I think, you know, to many in this audience, is that in the context of an investment by an SBIC, you often, or you would typically, the SBIC would typically have the right under the equity documents or a side letter to require that its equity be redeemed in the case of certain regulatory violations. Well, if your intercreditor agreement says that, well, to the extent that the equity carries any sort of mandatory redemption language, that has the effect of subjecting the equity investment to the terms of the subordination and intercreditor agreement from day one, and you don't want that. So it has to be a very tailored approach. And I think that's a good segue into Tamer's discussion of SBIC considerations.
Thanks. Yeah, and we'll just kind of run through this fairly quickly, but what you just mentioned, Christine, I'll start there with remedies, actually, because it's a really interesting and can be, it can have the potential for tripping up when you have, you have debt, you have equity, you have these SBIC requirements. And what we usually see is an SBIC side letter that contains within it all of the reps and warranties about the small business and other required thresholds for the business, as well as the ongoing covenants, informational and inspection rights, as well as a provision on remedies. And there are often we do see kind of different levels of remedies depending on the situation. Like if it is a violation by the company of a rep or warranty or covenant that then causes an SBA regulatory violation, meaning it's truly the company's fault. That's kind of one higher level of stronger remedies. And then there are also some call them remedies, but more what happens if the SBA comes in and says, somebody made a mistake and this investment doesn't qualify as a small business, so we need you to transfer talking to the SBIC investor, we need you to transfer this investment. So as Christine just touched on in one context, the other related thing you think about is okay, you have this side letter, which is very helpful to have it all in a side letter, all these provisions and remedies. But if there are any remedies that, for example, an equity redemption, you know, sometimes we see that, sometimes we don't agreed to. But if it's agreed to by the company, you know, that's great. But if you know, there's an LLC agreement or a stockholders agreement where in order to actually effectuate the redemption or the transfer, you need other parties to agree to that. You know, you just have to think through what documents do these remedies need to be in addition to the side letter. Maybe it needs to be included in the LLC agreement, the stockholders agreement, the loan agreement, and that sort of analysis needs to be done. The other things that just, you know, a few things that frequently come up in situations where there's a minority equity investor and a sponsor, and then separately a sponsor or independent sponsor. Those are the affiliation rules, which ties to the small business size test. They're, you know, in order to be a small business, if it's owned by, you know, Google, just because it's a separate entity, it's not going to be a small business. But if it's owned by a sponsor, or if a sponsor is investing, there are exemptions that apply to sponsors to effectively exempt the sponsor from affiliation. So you just need to run those analyses. And then the other one that comes up frequently is limitation on holding companies. You can only have 2 holding companies between the SBIC and the first operating entity. And this, frankly, it's different than a lot of, some sponsors will often have more than 2 holding companies. So it's just at the very outset, it's important to do the analysis. How many holding companies are there planned to be? Work through, there are ways to structure or to kind of resolve the issue, but it's one of those that really needs to be looked at the very outset. And then the other one that comes up that's applicable to this situation is the equity redemption. There are a couple requirements, but the more important, or the more applicable one here, I would say, is the pricing. How do you price that redemption? And the issue is, if you price it in a way that it's effectively truly an equity valuation that, for example, is based on a multiple of EBITDA, that works in terms of keeping that investment considered to be equity. If, however, you have a redemption price, which is basically you get your money back plus accrued dividends or accrued interest, even if it's like an either or, like you get the equity valuation or the kind of the more debt-like redemption price. If you have that, the SBA views the investment as a debt investment for purposes of the cost of money. So you would have to comply with you know, 14% interest rate or cost of money, which would be problematic for an equity investment, most likely. So there are workarounds, mainly through provisions to add to the side letter, where you essentially say, if this becomes an issue, then we're just going to use this equity valuation price, and the other one falls away. But it's just something you always have to keep in mind if you're an SBIC. Mike or Christine, anything to add on that? Or
I think you've covered it. You know, we've got just a few minutes left here, so if anybody has any questions for us, please type it into the chat. We're happy to answer it. This is, as you can see, our catch-all slide, so we can certainly slot in answers to questions while we're talking through this. You know, just a couple of other things to think about as you're making your equity co-investment or your debt investment. You know, taking a board seat or an observer seat. Frequently, lenders are adverse to taking board seats for a lot of reasons, but they do frequently want observer seats, especially when you have equity, in order to best monitor the investment. Powers of attorney are things that, you know, a lot of our clients are averse to, especially, you know, sophisticated funds who have been around for a while. don't want to give up power of attorney for just about anything, maybe certain administrative things or scrivener's errors, but anything substantive, you really want to push back on a power of attorney. You have to have, again, it goes back to the level of trust that you have with the manager. The manager has to have a level of trust in you that you're not going to do something completely crazy so that they would need a power of attorney. Management fees are another consideration when thinking about the economic deal that you're cutting. To the extent that you're allowing the sponsor to take management fees, would be both restricted in the debt documents, maybe with certain carve-outs, and restricted under the equity documents potentially. But understanding what kind of cash is flowing out to the sponsor, a key piece of the economic consideration. Indemnification, this is sort of a standard provision across pretty much every company we see. Indemnification of directors and officers against liability directly for company actions, having the appropriate carve-outs around fraud and gross negligence, another important consideration. If you were going to take a board seat, making sure that indemnification covers you. Sometimes if you're taking an observer seat, you want to try to get it to cover the observer, although frankly, there aren't really scenarios where the observer gets hit, so it doesn't make a ton of sense, but it's a conversation we've had a number of times. Fiduciary duty waivers, again, this is one that sponsors, particularly funds, always put in their documents that they, as the people running the fund, can consider their own equity interests as opposed to the broader interests of the company itself. When you're a fund controlling the board and controlling the equity, this is something you put in there. So thinking about how that plays through your documents is another thing to think about. And we touched on transfer restrictions a little bit within preemptive rights and ROFR, but generally there's going to be a restriction on transferring any equity without consent. As a fund, thinking about things like affiliate transfers, or successor type transfers, something that you want to think about whether that's an exception that you need from those transfer restrictions. So I sort of flew through that. I see we have one question, and Tamara or Christine, do you have anything else to say on these key things that I flew through, or do you want to tackle the question?
Let's see. The only thing I guess I would just add on the fiduciary duty waivers, this really applies in the LLC context, because in corporations, it's built into the corporate law, but a lot of these investments are in LLCs. And from a minority equity investor standpoint, it depends, partly, whether to push back on that. It depends, how broad the fiduciary duty waiver is, or how limited of, or maybe put better way, what is the threshold for a claim for breach? Is it just outright intentional fraud, self-dealing, or is it is it something less than that but not as low of a threshold as like gross negligence? And partly it depends on your position in the company. Do you have a board seat? If you don't, I would push back on the kind of the broader fiduciary duty waivers, and push for kind of the lower threshold to be able to make claims. So that's what I would say there. There was a question. Let's see. So the question was about side letters. Is it market to ask for MFN? Right, on possible side letters. So when I mentioned side letters before, it was really a more limited situation of SBIC specific side letters. And I guess although I very frequently see them in the private equity fund formation context, I usually don't see MFNs in this context, where the company would agree to share the side letters. But on the other hand, they are, if there is more than one SBIC in the deal, there's usually no issue giving all of them the same rights. I usually wouldn't, though, expect to see a non-SBIC get any additional rights that an SBIC is getting, such as, additional inspection or information rights, although those are probably already included in the debt provisions usually. Any other questions? I think we have 1 minute left.
I think we're right on time. So
That's perfect. Thank you, Tamara, Christine, and Mike. We appreciate the time and expertise that you have so graciously shared today. A replay of today's webinar will be distributed to SBIA members and will be available on our website at sbia.org. And our next Lunch and Learn webinar will be Tuesday, October 19th, and will feature a discussion about converting an SBIC to a BDC. And on October 27th, we'll explore the pending LIBOR transition. Details of upcoming webinars will be shared in membership emails on the SBIA website and on our social media accounts. In addition to the SBIA webinar series, we hope you'll participate in one of our upcoming fall networking events. Please visit the events tab on our website to learn more. And finally, if you are not an SBIA member and would like to learn more about our organization, please email membership@sbia.org. Thank you again for participating in our webinar today, and we look forward to having you join us at an upcoming SBIA event.